Welcome to Friday Live. Every Friday, some of the partners of HPK Provident get together and discuss what we're seeing going on in the markets, the economy, and tie in some of the financial planning topics that we speak about throughout the week. So today I have David Harper, and before I let him give his little intro, I'm glad to be back. I missed I think the last 2 out of the 3 Friday Live, so I was really missing being on video. So this week, instead of my look ahead post being in blog form, I did it video form just so I could show my face.
How nice of you, Mike. It's great to have you back. Okay. And I guess like most of the country, under inches, maybe perhaps feet of snow, and I think more coming. Yeah, even sometimes here in Florida, we get a little bit under the weather.
Yeah, I don't know what, I think it was Tuesday morning. We were 24 degrees at 7 a.m. We're not equipped for that kind of weather.
No, the iguanas tend to drop out of the trees when they get below 40. Alligators, yep. The alligators just stop eating. It's amazing that they could just have their nostrils above the water and the rest of it could freeze and they're fine. Happens in Myrtle Beach all the time. Now, we don't really get much snow down in the Everglades, but perhaps it may be helpful to get rid of some of those Burmese pythons.
So I didn't watch much of the football games this weekend now that my Jags are out, but did you watch them? Did they go as the way you thought?
Seattle is a beast. And the Rams had their moments, but Seattle stuck to it. Now, what happened in Denver and with the Patriots, that's rough. You better score your points when the sun is shining, because when the snow falls, at least out west and the Northeast, when the snow falls, it's a lot harder to throw that pigskin, let alone run it in the sludge. You just slide all over the place. So pretty low scoring affair. And
yeah, it looked quite snowy. And where was that? Denver?
Yes. Yeah.
So who's your pick for the Super Bowl? Not this Sunday, but I believe the following Sunday. Might be the 8th.
Yep, February 8th. So grab your popcorn, grab your nachos, and get yourself a nice seat. And hopefully there's a fireplace nearby and you can enjoy your game.
All right. So this is our typical blog post schedule. We do Market Monday, where I usually do the blog post. This week, like I mentioned, I did a video form, but just talking about kind of what happened in the past week economically in the markets and what I'm looking at going forward in the upcoming week. Then Tax Tuesday, Brian's been doing a great campaign of talking about different tax tips you can do to maximize your after-tax income. And then Wealth Building Wednesday, just some financial planning tips there. Think Ahead Thursday, things to be thinking about in your financial future. And then, as always, Friday Live at 12:30 p.m. Eastern time, where we do this format and discuss the blog post, markets, and the economy. So where would you like to start this week? Should we start with Market Monday?
Well, and we also had the webinar on Wednesday as the outlook goes. Let's start with a recap of the outlook of the market for 2026.
All right. So first, I'm gonna, start with the chart. So yesterday we had a big drawdown and ended up recovering. I think the S&P was down 1.3% at the low end. Ended up finishing, I think, negative 0.15%. I think the Dow might even flip positive. Today we were down about 0.5 or so at the lows. We've rebounded a little bit. But the big news today is PPI and the Fed chair announcement. So when you think about really both of those dynamics, PPI came in hot for sure. It was at let's see. The headline rose 0.5% for the month, 3% on a year-over-year basis versus expectations of 2.8%, while core rose 0.7, which is extremely high for the month, and coming in at 3.3% year-over-year versus expectations of 2.8%. So that is, I would say, not being reflected in the 2-year. Are you guys seeing? Yeah. Okay. Just to make sure you're seeing the chart. So it's not being reflected in the 2-year. Typically, a high inflation reading like that would cause the 2-year to jump quite a bit. But really, the 2 years, and Jeffrey Gunlock makes a good joke about this, like who he wants the next Fed chair to be. The 2-year Treasury, because that's where it should be. And the range that we are in, that the Fed kept us in this week, is 3.5 to 3.75. So we're right in that range. It was looking like Rick Reeder was going to be the favorite pick for Fed chair after Kevin Hassett, where Trump said that, he likes Hassett too much to give him up to the Fed. So actually he went with Kevin Warsh. Historically has been more on the hawkish side. He was very instrumental in the 2008 financial crisis. So his big concern is the balance sheet, that it's way too high. So that's going to make him more prone to cutting rates, I would say, because those interest payments are becoming quite large. So I think that's why the PPI numbers reflected in the 2-year being more offset by the Fed pick. On the longer end, which kind of is more reflective of what inflation is going to do, what the economy is going to do, it did break above that downtrend line, but barely. It could be a false breakdown. So if we get back below 420, I think the trend is still lower, but given government debt, I think it's more likely that that's going to remain on the high side. So even if the Fed cuts rates at the short end, the Fed funds rate, I think we're more likely to stay a little higher on the long end, which is kind of negates the impact on the economy, especially the housing market and cyclical industries. So S&P's done pretty well for the month. It's a little up over 1% as we speak now for the month of January. But it's really been a different picture than what we've seen in previous years where, the Mag 7 was really the driver of performance. This year it's the opposite. The Mag 7 performance hasn't been that great, but the other 493 has been doing pretty well, specifically industrials, commodities, which we'll speak about a little further, materials in general, regional banks, not the large banks, and then international markets are doing a lot. So international markets tend to do well when the dollar is a little weaker. So that can be the case there.
Which is good.
Yeah.
It's nice to see, Mike, that there's some broadening of the market instead of being so concentrated with the Max 7.
Yeah, that is healthy. And looking at the chart of the S&P 500 market weight, especially looking at the RSI figure, which is a momentum indicator, we've been inching up to new highs on the S&P for a while. Even though we're essentially flat since October, we've made marginal distance above that level. But RSI has not kept up with it. And typically when you see that kind of divergence, it's meaning there's some underlying weakness under the surface. But actually the broad index, like the equal weight, is doing much better on the year. The Dow is doing much better. I think the equal weight's above 2% year to date. Small caps are doing very well, up around 8%. They were closer to 10%, but gave back a little toward the end of the last week. So we're really in the heart of earnings season right now.
Fundamentally, companies are making money. People have money in their pockets to spend. So the consumer-driven economy that is so important to us, people are buying. So it seems like odd. I think that's a pretty good picture that policies, what the administration happens to do, has had a pretty big, significant impact on market gyrations. Certainly, market volatility. Okay,
Oh yeah,
going up and down. It's like
the 2% move down the previous Tuesday because of the talk of buying Greenland and then them backing off. It's a negotiating tool of the 10% tariff. So yeah, definitely government policy has a big impact. And that takes us right into the Fed meeting. He seemed to think so. They didn't cut interest rates. They left it in the range of 3.5 to 3.75. But he seemed pretty confident that his two dual mandates of employment and stable prices aren't fighting against each other anymore, which, I can't say I'm a big believer of that. As we saw today, PPI was very hot. The last CPI report did come down, but maybe we were still shaking off some of the effects of the government shutdown affecting the data. And then on the employment side, non-farm payrolls has been pretty weak. I mean, we did see a little better reading this previous month at 50,000, and the unemployment rate ticked down to 4.4%. But I don't have a high conviction level that that's going to continue downward. With it, productivity is insane because of AI. And if anything, I think that'll cause the unemployment rate to remain higher. It's certainly not coming from job growth because that's been weakening. So I think we had an announcement, probably 5 companies this week announcing layoffs, and a lot of that has to do with AI spend. I forget which company put it out, but they were predicting that because of AI, it could reduce the non-farm payrolls number by 20,000 a month. So I think we're essentially like barely in positive territory for non-farm payrolls. So my inclination is that the unemployment rate's probably going to start to tick up. Given the PPI number being so hot, we could see elevated readings over the next couple quarters, especially as tariffs kind of settle in a little more. But beyond that, I don't think long term. I think on the back half of the year, given the weakening of the labor market, that inflation will probably kind of settle back down. So earnings this week, shifting topics. We had a lot of the Mag 7. We had Meta, Microsoft, and Apple report, and Tesla. And I mean, it was pretty 50-50 with those. Actually, I think the only real positive one was Meta. They're up 10%. I guess spending was under control. Their guidance was good. On the flip side, Microsoft is spending too much, and cloud growth is on the weaker side, even though it's still strong. It just wasn't what the street was looking for. So overall, I think 135 companies have reported on the S&P 500, and we're at about 77% beat rate, or 75% beat rate, which is pretty good for earnings. It's pretty close to the 5-year average. And the bar is pretty high. I think we're expecting above 8% earnings growth for the quarter. And on a full year, which makes me a little concerned, I think the number is expected to be 14.8%, which is very strong. And you say, oh, that should be a great year for the stock market. But unfortunately, based on that 14.8% growth, we're trading at 22.5 times earnings. So the bar is on the high side.
Which means there's some benefit to look at other value plays outside the country. That's the case for internationals. So you don't be surprised if you see Mike picking up some good international plays for our portfolios. We will never overweight international. We like our domestic markets, don't we, Mike?
We do. There is a term in behavioral finance called home bias, which I would say I'm certainly subject to, but in my tenure in this career, I've seen very few years of international performance, but last year was one of them. This year could very well be another one, especially if the dollar remains weak. So going into our blog topics for the week, Brian did the Tax Tuesday blog post, which highlights QCDs, qualified charitable distributions. So basically what that means is once you hit age 70 and a half, you can start taking some of your distributions from your IRA and transferring them directly to a qualified charity. So the benefits of that are you don't get taxed on that amount. So it also doesn't go into the components that go into Medicare and Social Security taxation. And then once you hit the RMD age of 73, it can satisfy that without having to pay taxes on it. Anything to add on that?
With the benefit that if you have a sizable amount in your retirement account, your RMDs could really put you in the next tax bracket or further. So trying to trim your retirement accounts is not a bad idea, and to help the charity of your choice, that sounds like a win-win situation. And that's what the government is set up to do, is as those qualified charitable donations. So.
Yeah. And then Wednesday we had a post Brian put out that was about just LPL's market outlook. I don't think we needed to go into that. I got the markets covered here. Maybe I'm a little biased, a little cocky, but
simple fact is 2026 is going to be a lot like 2025, just with a little bit of volatility, probably more volatility, but understand that we still like where the market is heading for 2026, and believe we'll probably use those drawdowns as buying opportunities.
Yeah, and we have been building up more cash because I think the odds of at least a correction are heightened this year, if not a full 20% decline, which would be a bear market. I don't think I'm really in that camp at this point, but I think it's likely we'll see a 10% pullback. If I had to bet,
probably
first half of the year,
quarter.
But probably. I mean, I'm going to go with seasonal patterns. Summer months, second and third quarter.
Yeah. So you think the first quarter will? First quarter last year was pretty rough.
That's true. We did have a near bear market. I think we got
19.8%
drawdown. And then it's been pretty much a straight shot up. We had some volatility in the fall, but overall minor drawdowns. So yeah, typically the months from, I'd say, October through March, April are the strongest period of the year. And then as the saying goes, sell in May and go away. Might be the case this year. I don't think last May was bad. I think that's where we started having the recovery from that almost bear market. So historical patterns don't always shake out. The second year of a presidential cycle is the weakest of the 4-year cycle. So that's another component we're dealing with. But we're very flexible with our positioning. We're able to maneuver around. So we tend to do that. And we have enough cash position to take advantage of a pullback currently based on individual stock charts. Maybe I'll add a little bit more to that if I start seeing a particular company's stock breaking down and breaking like a trend line. But besides that, at least at this point, we're probably still going to be buyers of dips.
Yep.
So we had a post on Thursday talking about the boom that we've seen in the commodity market, specifically precious metals, silver and gold. Oh my goodness.
Okay. Well,
and I gotta pull up
metals.
The daily chart doesn't do it justice here. I gotta pull up a weekly chart at least. Let's see. Let's go back a bunch of years here. So you can start talking about your.
Okay. So when we think about precious metals, when we think about commodities, we're talking about something that's not really tied to the stock market or bond market. These are considered alternative investments. And we do have alternative investments in your portfolio that Mike has built in because there's portions. And you can see that huge run on gold.
This is GLD, the gold ETF by Spider, and it dates back to, I think, doesn't go back too far, but down to, I think, 07. But you just see this parabolic move over the last 6 months. It's just insane. Today we're down close to 7%. Silver, another one, which started a little later in this trend, but I gotta figure out this chart here.
Okay. But
it won't even adjust automatically.
I read a very fascinating article by Jeff Childers. Okay. Now, Jeff Childers is he's a lawyer up in Gainesville. He runs a post called Coffee and COVID. He got started on this during the COVID when the powers that be around Gainesville really wanted to shut down most activities, and he felt that wasn't fully necessary, and he faced backlash on that, and he started doing the posting on free markets and on independent thinking. Okay, and he had a blog, a podcast on gold and precious metals. And it's a fascinating read. I would recommend you pull it up under Coffee and COVID. Intriguing that the U.S. has a stockpile of, and this is from his podcast. They have a stockpile of 262 million ounces of gold. Okay, now right now the U.S. Treasury counts that at $44.25 an ounce, which is about $11 billion. Okay, well, if you end up putting that at fair market value and gold went above 5,000, I think yesterday it went above 5,500. We're talking about a 1.3, 1.4 trillion. That's quite a big jump. And if it's a thought of how can you monetize gold, don't put it past the present administration to use that. And there was some thought that gold has been artificially suppressed. The prices hasn't really gone with the fair market value, which seeing this kind of growth in the last 6 months, Mike, caused me more than just scratch my head. Maybe there's some truth to that. It had happened in the past. Okay. So
yeah, look at this 3-month chart of silver, almost 100%. 6 month, I don't think we really got the jump until 6-7 months ago. So we're looking at a 200% potential gain in silver over that time period, just parabolic. And you really get a sense of, we've probably gone too far too quick when you start running into people at the supermarket and they're asking you, well, what do you think about silver and gold right now? Okay, let's pump the brakes for now. Commodities tend to have these big super cycles, so I'm not saying it's dead, but it's just gone very fast, very quickly.
Well, there's some thought that by Mr. Childers that it's not done. The run is not done. Now you don't want to be the last party on the Titanic. Okay, so we don't see any drop. We don't see any blow up on this.
Well, silver's down 18% today, but
well, it's only up 100% the 3 months prior. So to give back 18%, I'm okay with that.
Yeah, it's still up 30% year to date.
So, and that's since January 1st.
Mm-hmm.
Wow. Well, if you're a numismatic, such as myself, and you like the art value of gold and silver coins, enjoy those pieces. But you might want to look at some of the dingier ones, what they call as spot silver, spot gold. You might want to maybe cash into some of those chips. All right, trim that side. But again, the place for gold in your portfolio is in the arena of alternatives. Okay. and you really shouldn't have more than 5-10% is really high on that side. Okay. So if you find yourself with a chest full of gold in your backyard, yeah, you better start cashing some of those in. Okay.
Yeah, maybe. I mean, the precious metals are likely to be pretty volatile in the near term. But you're starting to see some good movements out of some of the other materials. Like I'm just personally looking at a chart of steel manufacturer right now. It's had a nice run year to date. Not quite back up to its previous highs, but potentially, depending on where the economy goes, that might be a better place to look if you're looking at the material sector.
Yeah.
But typically, materials as a whole, well, like first of all, precious metals tend to do well when there's some more concern in the markets, which we're right by market highs, so that's not necessarily the case. They tend to do well when the dollar's weak, which is
geopolitical unrest, okay,
and potentially lack of faith in like government policy, like
yes.
how there was supposed to be the huge Doge audit, and like you were talking about looking at Fort Knox or whatever for gold bars.
Is the gold really there?
And just the questionability of Fed independence, like the Fed chair is appointed by the president. The president picks someone who's going to lower interest rates. So
There's some say to that. I mean, the amount of service debt on the amount of government debt that the U.S. holds, and this just paying the interest payments on that is becoming mind-boggling. So for every quarter of 1% that's cut, saves billions of dollars just on the interest payment. So
so maybe contrary to my point earlier, maybe cutting enough on the short end will ultimately bring down the long end as long as inflation remains under control.
Yeah, that's a key. You don't want to be giving out easy money because then the inflation will just go up. So, all right.
All right. Well, the month's about to wrap up. Looks like it's going to be a good month. Next week, first Friday of the month, we get non-farm payrolls. So we'll see what that has to tell us. Should give a little better picture of what the labor market's actually doing. Well, with that, we'll get the unemployment rate, wage growth. So a very good week for important economic factors, and we'll have another slew of impactful S&P companies reporting. So should be a potentially market moving week. So we'll see if we break out to the upside or maybe take a leg lower.
Good.
I'm not giving any hints right now. You have to tune in next week.
All right. Thank you, Mike, very much. Everyone, have a great weekend. Our partner Brian is enjoying a time with the family up in New York and Long Island to see Alex play some hockey.
All right. Well, good luck to them. I heard they had the previous week they were playing one of the top tiers in the country.
Number one team in the country.
And I forget what level he plays at. It's not D1, but regardless, very competitive hockey.
Oh, yes, very much so. Thank you, gentlemen. Thank you, folks.
And before we go, I'm going to flip on the disclosures, and then we just keep an eye out for the blog posts, and we'll see you next Friday at 12:30 Eastern Time.
Securities offered through LPL Financial, LLC, member FINRA and SIPC.org. Advisory services offered through LPL Financial, LLC, a registered investment advisor. Brian Peluso, Michael Kutch, and David Harper are registered representatives of LPL Financial, LLC. Content discussed is for informational purposes only and not intended as an offer or solicitation to buy or sell any security or investment strategy. Any opinions expressed are those of the authors and do not necessarily reflect the views of LPL Financial or its affiliates. All investments involve risk, including the possible loss of principal. This communication may include links or references to third-party websites. These links are provided as a convenience only. LPL Financial and its representatives are not responsible for the accuracy or content of such sites. Brian, Mike, and David and HBK Provident Advisors may only transact business in states where they are properly registered or exempt from registration. Please contact us directly for information regarding licensing and registration status. Past performance is not indicative of future results. You should consult with your financial advisor, tax professional, and/or attorney regarding your specific situation before making any investment decisions.